On April 10, 2024, in Brussels, Belgium, finance ministers from the Group of Seven, G7 nations, convened for a private deliberation. The central item on their agenda was the disposition of Russia's immobilized financial assets. Since February of 2022, Western nations had held $300 billion of the Russian central bank's holdings, frozen but not confiscated. These funds resided in accounts at Euroclear in Belgium, the Federal Reserve Bank of New York, and the Bank of England, inaccessible to Russia, yet unappropriated by the West. For 2 years, this frozen wealth served as a negotiating tool. Relinquish Ukraine and retrieve your assets. However, by April of 2024, with the conflict entering its third year, Ukraine's financial resources dwindled and U.S. congressional aid remained stalled. A change was inevitable. Within that conference room, a pivotal decision was reached. The G7 would seize the interest generated by these assets. The $300 billion yielded approximately $3 billion annually in interest, which would subsequently be channeled to Ukraine. The official announcement arrived on April 30, 2024, with headlines hailing it as an act of justice, proclaiming that Russia's frozen funds would facilitate Ukraine's reconstruction. It was presented as an ingenious, creative, and punitive measure short of outright confiscation. Yet in the boardrooms of central banks worldwide, from Beijing to Riyadh, New Delhi to Abu Dhabi and Brasilia, a starkly different discussion was unfolding. Ministers posed a critical question to their staffs. If this action could be taken against Russia, could it be taken against them? The unequivocal answer was yes. If the West possessed the authority to freeze $300 billion for political objectives and then redirect those funds to finance a conflict against the asset owner, then any nation's reserves held in dollars, euros, or pounds were inherently at risk. A nation's sovereign wealth, it seemed, was only sovereign until that sovereignty was challenged. Consequently, quietly and without fanfare, central banks globally embarked on a course of action, not witnessed on such a scale in half a century. They began divesting from U.S. Treasury bonds. This was not a sudden sell-off, nor a panicked liquidation, but a deliberate, systematic, and sustained reduction month after month. By December of 2024, a mere 8 months after the G7's pronouncement, foreign holdings of U.S. Treasuries had diminished by $400 billion. China alone had offloaded $89 billion, Japan $95 billion, and Saudi Arabia $32 billion. This pattern of divestment represented not typical profit-taking, but a concerted global strategic maneuver away from U.S. Treasuries, directly precipitated by the decision to repurpose Russian interest. And this was merely the commencement. Herein lies the comprehensive account of how this situation materialized, detailing the precise mechanism through which the seizure of Russia's $300 billion triggered a worldwide exodus from treasuries. It will present empirical data illustrating the ongoing trend, identify the nations engaged in selling and their alternative investments, and explore who is absorbing these sales. It will further examine the implications when the buyer of last resort becomes the Federal Reserve, effectively signifying the collapse of the treasury market. This issue transcends the plight of Russia, which lost $300 billion. The true ramifications lie with the United States. By weaponizing the treasury market, the U.S. has undermined the very foundation of its global influence, the ability to secure unlimited borrowing at minimal interest rates, a privilege born from the world's unparalleled confidence in U.S. debt. That trust has evaporated, and once lost, it is virtually irrecoverable. Prior to February of 2022, the U.S. Treasury market stood as the world's most profound, liquid, and trusted financial arena. Total U.S. government debt held by the public stood at $24 trillion, with foreign entities holding approximately $7.6 trillion, constituting roughly 30% of the total. China held $1.1 trillion, and Japan held $1.3 trillion. These figures represented a stable, decades-long norm. Foreign nations accumulated dollars through trade surpluses, necessitating secure repositories for their holdings. U.S. Treasuries presented the logical solution, offering safety, liquidity, and the backing of the United States' full faith and credit. Moreover, Treasuries were considered apolitical. While the U.S. had previously frozen assets of adversarial nations, Cuba, Iran, post-1979, North Korea, Libya, Venezuela, these were relatively small states, acknowledged adversaries and rogue actors. The established understanding was that countries maintaining normal diplomatic relations could rest assured of the safety of their treasury holdings. This implicit guarantee was the cornerstone of dollar dominance, enabling the U.S. to sustain perpetual budget deficits as the global market consistently absorbed its debt. This constituted the exorbitant privilege. On February 24, 2022, Russia launched its invasion of Ukraine. Within 72 hours, Western powers announced the freezing of Russian central bank reserves, amounting to a total of $300 billion. $100 billion held at Euroclear, $100 billion at the Federal Reserve Bank of New York, $50 billion at the Bank of England, and $50 billion across other European central banks. This action was unprecedented, not due to asset freezes in general, but because Russia was not a pariah state like North Korea. Russia ranked as the 11th largest global economy, a major energy exporter, and a permanent member of the United Nations Security Council. Furthermore, Russia possessed $600 billion in total reserves, of which $300 billion were denominated in Western currencies, maintained as a safeguard against sanctions. Russia had diversified its reserves into Western currencies under the assumption of their security. This assumption proved to be erroneous. Every other central bank took immediate note. While public reactions were subdued, private discussions among central bank governors were intense, leading to emergency meetings. The universally posed question was, what proportion of our reserves is vulnerable? For China, the implications were alarming. China held $3.4 trillion in foreign exchange reserves, with approximately $1.1 trillion in U.S. Treasuries, and an additional $500 billion in other dollar-denominated assets, potentially rendering over $1.5 trillion susceptible should relations with the U.S. deteriorate. Saudi Arabia held $120 billion in treasuries, the UAE $40 billion, and Taiwan $240 billion. South Korea held $170 billion. Every nation with substantial dollar reserves recognized that their holdings were effectively hostages to U.S. foreign policy. If the U.S. could freeze Russia's $300 billion for invading Ukraine, it could, in principle, freeze any nation's reserves for reasons deemed sufficient by Washington. These reserves were no longer safe, they had become leverage. However, the freeze alone was insufficient to precipitate widespread selling. Central banks operate with considerable deliberation. There was an initial hope that the freeze was a temporary measure, specifically linked to the Ukraine conflict, and that normal financial protocols would be reinstated upon its conclusion. This hope was extinguished on April 30, 2024. The G7's declaration that Russia's frozen assets would be utilized, with the generated interest transferred to Ukraine, represented a transgression. This was not a freeze pending resolution. It was the confiscation of assets and their transfer to an adversary of Russia. The legal rationale employed was novel. The interest, distinct from the principle, meant Russia technically retained ownership of the $300 billion, while the West was merely appropriating the profits. Nevertheless, from a central banking perspective, this distinction was immaterial. When an entity possesses an asset and its generated income is diverted, effective ownership is compromised. This event served as a potent signal that treasury holdings could be confiscated for political reasons, thereby accelerating the selling trend. Publicly available data, released monthly by the U.S. Treasury, reveals the post-April 2024 activity. From April through December of 2024, foreign holdings declined by $400 billion over 8 months. China sold $89 billion, Japan sold $95 billion, Saudi Arabia sold $32 billion, Belgium, which manages Middle Eastern funds, sold $25 billion, and the Cayman Islands, acting as a conduit for Chinese institutional funds, sold $18 billion. This constitutes the most substantial sustained foreign divestment from U.S. assets in history, outside of periods of financial crisis. Furthermore, this represents only the initial phase. Central banks do not liquidate their holdings en masse to avoid precipitating market crashes and devaluing their remaining assets. The selling observed thus far is merely the cautious vanguard. The true wave is yet to come. Previously, when foreign central banks were the principal purchasers of treasuries, the US could borrow indefinitely at low rates. The Treasury would issue bonds, and foreign central banks would acquire them, thereby maintaining low yields even as national debt expanded. However, when foreign central banks cease buying and begin selling, another entity must step in. There are four potential sources of demand: domestic institutions, domestic households, foreign private investors, and the Federal Reserve. Domestic institutions, such as pension funds, already hold $6 trillion in treasuries and cannot significantly increase their holdings without incurring excessive risk. Domestic households hold $3 trillion and are not expanding their investments. Foreign private investors face the same concerns regarding asset freezes as central banks. This leaves the Federal Reserve as the primary potential buyer. The Federal Reserve is mandated to operate independently of the Treasury. However, in the absence of other buyers, the Fed must intervene to prevent a surge in yields and avert a fiscal crisis. This scenario is known as debt monetization, the central bank creating money to purchase government bonds, a practice employed by nations like Zimbabwe, Weimar Germany, and Venezuela, all of which ultimately experienced rampant inflation or currency collapse. This process is already underway. In early 2024, the Fed held $5 trillion in treasuries. By December of 2024, this figure had risen to $5.2 trillion. Despite its stated intention to reduce its balance sheet, the Fed is once again acquiring bonds because someone must purchase them. Foreign central banks are selling $400 billion annually, and domestic buyers are not increasing their purchases. Consequently, the Fed is absorbing the selling pressure. The Fed's share of the overall Treasury market rose from 20% in early 2024 to 22% by year-end, representing a 10% increase in Fed ownership within 8 months. This marks the nascent stage of a debt monetization downward spiral. Let us examine the specific countries engaging in this divestment and their motivations. China has reduced its Treasury holdings from $1.1 trillion in March of 2024 to $980 billion by December, an 8-month reduction of $120 billion. China's rationale for selling stems from two primary factors. Firstly, observing Russia's predicament, China recognizes its own vulnerability should it pursue objectives concerning Taiwan. Secondly, China is actively preparing for a post-dollar global economic order, developing its cross-border interbank payment system, CIPS, negotiating oil transactions in yuan, and extending credit to Belt and Road countries in yuan. Japan has reduced its holdings from $1.2 trillion to $1.1 trillion, a decrease of $100 billion. Although an ally of the US, Japan faces its own fiscal challenges, needing to finance its national debt, which stands at 260% of its gross domestic product, GDP. Consequently, Japan is selling treasuries to finance its own borrowing requirements. This is particularly significant given Japan's consistent role as a primary purchaser of US treasuries for the past 30 years. Saudi Arabia has decreased its holdings from $135 billion in 2023 to $90 billion by the end of 2024, a 33% reduction over 18 months. While an ally of the US, Saudi Arabia, witnessed the freezing of Russian reserves and questioned the potential for its own reserves to be similarly targeted. The answer, it concluded, was yes. Should Saudi Arabia curtail oil production against US wishes or align too closely with China, the US could freeze its reserves. Saudi Arabia is therefore diversifying its assets, increasing its gold holdings, accepting yuan for oil transactions, and joined the BRICS bloc in January of 24. The United Arab Emirates, Kuwait, and other Gulf states are following Saudi Arabia's lead. Collectively, Gulf countries reduced their treasury holdings by $80 billion in 2024. This divestment is a global phenomenon, coordinated not through clandestine collusion, but through a shared sense of apprehension. Every central bank that observed Russia's experience has opted to reduce its exposure to Treasuries. Their alternative investments? Gold. Central bank gold acquisitions in 2024 surpassed 110 tons for the third consecutive year, marking the highest sustained buying trend since the 1970s, just prior to the collapse of the gold standard. China officially purchased 225 tons in 2024, with unofficial figures likely exceeding 400 tons. Turkey acquired 80 tons, India 75 tons, and Poland 60 tons. The appeal of gold lies in its immunity to freezing. Gold held within a nation's own vaults remains unequivocally its own. Russia's gold reserves located within Russia were never subjected to freezing. Only Western-held reserves were impacted. This has led every central bank to conclude that domestic gold holdings are the most secure. Regarding other currencies, the yuan's share of global reserves has risen from 2.3% in 2022 to 3.2% by 2024, a 40% increase in 2 years. While still considerably smaller than the dollar's 58% share, its upward trajectory is evident. Furthermore, some central banks are acquiring strategic commodities, such as oil, copper, and rare earth elements, assets possessing intrinsic value that cannot be digitally frozen. The overarching pattern is clear: a diversification away from treasuries. And as this diversification intensifies, the pool of buyers for new U.S. debt shrinks. This creates a mathematical conundrum. The U.S. government consistently runs annual deficits of $2 trillion. The total borrowing requirement amounts to $7 trillion annually, comprising $2 trillion in new borrowing and $5 trillion to refinance maturing debt. Prior to 2022, foreign entities purchased approximately 30% of new issuances, roughly $600 billion per year. Domestic buyers accounted for 50%, or about $1 trillion. The Federal Reserve purchased 20%, approximately $400 billion. Now, following the G7 announcement in April of 2024, foreign buyers are selling $400 billion annually instead of purchasing $600 billion, a swing of $1 trillion. Domestic buyers have not increased their purchases, necessitating the Federal Reserve to step in and cover the shortfall. The Fed's acquisitions have surged from $400 billion to $1.4 trillion annually to absorb both new issuance and foreign outflows. This implies that the Fed is now purchasing approximately 70% of net new Treasury issuance when accounting for foreign sales. When the central bank becomes the market has fundamentally failed. This initiates a self-perpetuating cycle. The Fed's purchases of Treasuries equate to money printing. Money printing fuels inflation. Inflation diminishes the real value of Treasuries, prompting foreign holders to sell even more, which compels the Fed to purchase more, thereby printing more money, exacerbating inflation, and triggering further selling. This is the pathway through which a currency loses its reserve status. Let us examine the projected timeline. In February of 2022, Russia's $300 billion were frozen, planting the initial seed of doubt. During 2022 and 2023, cautious diversification began, with China and Saudi Arabia initiating gradual reductions in their treasury holdings. In April of 2024, the G7's announcement regarding the utilization of Russian assets transformed doubt into certainty, accelerating the selling trend. From 2024 through 2025, foreign selling is anticipated to intensify, with outflows ranging from $800 billion to $1 trillion annually. The Federal Reserve's purchases will escalate to compensate for this trend. By 2026 to 2028, a critical juncture will be approached. Foreign holdings will fall below $6 trillion, while Fed holdings will exceed $7 trillion, representing 30% of all outstanding treasuries. Markets will begin to price in inflation risk, leading to a rise in 10-year yields from 4% to 6 or 7%, despite Federal Reserve intervention. From 2029 to 2032, the crisis will become manifest. Treasury auctions will begin to fail, and yields will surge to 8 to 10%. U.S. interest payments on its $40 trillion debt will exceed $3 trillion annually, consuming 60% of tax revenue. the Federal Reserve will be compelled to substantially increase its purchases. Looking further ahead, from 2033 to 2037, a currency crisis will unfold, and the dollar will relinquish its reserve currency status, its share diminishing in favor of commodities. The dollar's proportion of global reserves will fall from 58% currently to between 40 and 50% by 2040. While still the largest single currency, it will no longer hold hegemonic power. The US will be forced to balance its budget or face hyperinflation. This projected timeline assumes a gradual decline. However, it could accelerate due to unforeseen events, such as an invasion of Taiwan, a major bank failure, or a political crisis. Regardless of external shocks, the mathematical outcome remains consistent. When the central bank becomes the primary purchaser of government debt, the currency's demise is inevitable. Who stands to gain and who stands to lose? China emerges as a strategic victor. It is divesting from treasuries, accumulating gold and commodities, and constructing an alternative payment system through SIPs. As the dollar's reserve status wanes, the yuan is poised to ascend by default. China is proactively preparing for a post-dollar era, while the United States remains entrenched in its defense of dollar dominance. Holders of gold are also positioned to benefit. As central banks shift their reserves from treasuries to gold, its price is expected to rise. With gold currently trading around $4,300 per ounce, and central banks continuing to acquire 1,000 tons annually for a decade, gold prices could reach $7,000 to $8,000 by 2035, representing a 200% return. The United States faces the loss of its hegemony, the capacity to borrow unlimited funds at low interest rates, which underpins its military expenditures, Social Security, Medicare, and enables Americans to consume more than they produce. When the Treasury market falters and borrowing becomes prohibitively expensive, these vital programs will become unsustainable. The $880 billion military budget, manageable at 3% borrowing costs, becomes untenable at 8%. American consumers will experience a decline in purchasing power. The U.S. imports $3,800 billion worth of goods and exports $3 trillion, resulting in an $800 billion deficit. This imbalance is sustainable only when the world readily accepts dollars. As the dollar depreciates, imports will become more expensive, with the prices of gasoline, electronics, and clothing potentially rising by 30 to 50% over a decade. Holders of U.S. Treasury bonds will suffer wealth erosion. If yields increase from 4% to 8%, existing bonds will lose 30 to 40% of their value. Domestic institutions, holding $9 trillion in treasuries, face potential losses amounting to $3 trillion. Retirees will experience diminished financial security. As the dollar's purchasing power erodes, Social Security and Medicare benefits will decline in real terms. A monthly check of $2,000 today might only purchase goods valued at $1,000 in 2035. This represents the diffuse cost of reserve currency collapse. Not a sudden collapse, but a gradual erosion over 15 to 10 years. The irreversibility of this trend stems from the fact that the Treasury market is predicated on trust. For 80 years, the global community trusted that U.S. Treasuries were secure, irrespective of political considerations. This trust enabled the United States to borrow at privileged rates. However, trust, once fractured, is exceedingly difficult to mend. Russia's reserves were frozen, and their generated interest was effectively confiscated. Every central bank witnessed this event, and it cannot be unseen. Central banks are cognizant that U.S. law, specifically the International Emergency Economic Powers Act, empowers the president to freeze foreign assets merely by declaring an emergency. Ukraine was deemed an emergency. Taiwan would undoubtedly be classified as such, and any situation could be construed as an emergency. Consequently, no central bank can be assured of the security of its reserves. In the absence of trust, diversification becomes imperative. The United States could re-establish trust by revoking the president's authority to freeze assets, but this is highly improbable, as asset freezing is considered too potent a tool. Alternatively, the U.S. could entrust assets to a neutral third party, such as the Bank for International Settlements, but this would entail a relinquishment of control. There is no viable path to restoring trust without divesting the instrument of power, and the United States is unwilling to relinquish this weapon, even though it is actively undermining the very foundation of its global influence, the Treasury market. A historical parallel exists. In 1914, Britain weaponized finance by seizing German assets during World War I. Neutral nations observed that Britain would confiscate assets for political motives, leading them to diversify away from pounds. Following World War I, New York began to eclipse London as a financial center, and by 1944, at the Bretton Woods Conference, the dollar formally supplanted the pound as the primary reserve currency. Britain's financial dominance persisted for 30 years after the 1914 weaponization. The United States froze Russia's reserves in February of 2022. If historical patterns hold, the dollar could lose its reserve currency status by 2052. However, contemporary technology accelerates these dynamics. Central banks can now reallocate reserves in a matter of hours rather than months. China's CIPS system expanded from $12 trillion in 2020 to $27 trillion in 2023, doubling in just 3 years. My projection suggests that the dollar will lose its reserve currency dominance by 2037 to 2042, approximately 15 to 20 years following the 2022 asset freeze. The dollar's share of global reserves is expected to decline from its current 58% to between 35 and 40% by 2040. While still the most significant single currency, its hegemonic position will be relinquished. The catalyst for this shift was the freezing of Russia's $300 billion, and specifically, the April of 2024 decision to utilize these assets. That moment irrevocably shattered trust. In February of 2022, the United States faced a choice: freeze Russia's reserves as leverage, or accept that financial warfare has inherent limitations. The U.S. opted to freeze Russia's assets, a decision that could be defensible. However, in April of 2024, the U.S. made a different choice: to deploy the frozen assets by appropriating their generated interest and transferring it to Ukraine. This action crossed the line from freezing to outright confiscation, thereby destroying the Treasury market. Once reserves are confiscated, every nation understands that its own reserves are no longer secure. Trust in the United States has been irrevocably broken, and when trust is lost, the privileged financial position is extinguished. The Treasury market is in a terminal decline. Foreign central banks are divesting at a rate of $800 billion to $1 trillion annually. The Federal Reserve is intervening to compensate for this outflow. The Fed's share of Treasury holdings is approaching 30%. When a central bank owns 30% of a nation's government debt, it approaches the definition of a failed state. The projected timeline is 15 to 20 years. By 2037 to 2042, the dollar will no longer be the dominant reserve currency, and the Treasury market will cease to be a safe haven. The United States will be unable to borrow unlimited amounts. The era of free lunches will be over. The decisive trigger was the seizure of Russia's $300 billion. The United States gained $300 billion in frozen assets, but it lost the trust that underpinned $7.8 trillion in foreign Treasury holdings, a loss ratio of 26 to 1. Russia lost $300 billion. America has forfeited its financial empire. The primary beneficiary of this self-inflicted wound is China, which has observed, learned, and strategically prepared while the United States dismantled its own advantages. Witnessing the potential demise of the Treasury market stemming from the April 2024 proclamation, and grasping that international monetary authorities are currently divesting themselves of these securities, while the Federal Reserve increasingly assumes the role of ultimate purchaser. If you perceive this as the initial phase of the dollar's erosion as a global reserve asset over the ensuing 15 to 20 years, then consider subscribing, as the subsequent presentation will illuminate the ramifications of Treasury yields surging to between 8 and 10%, rendering the United States unable to manage a $40 trillion national obligation. The tripartite alternatives available are reneging on Social Security and Medicare commitments, devaluing the debt through rampant inflation, or undertaking a fundamental reorganization into localized monetary systems. Each of these paths would bring ruin to the American middle stratum. The $300 billion seized from Russia is projected to inflict a cost of $30 trillion upon America in diminished Treasury demand over 2 decades, representing a staggering 100-fold decrement. The integrity of the secure asset has been compromised. The Treasury market has been annihilated, and this self-inflicted wound was brought about by their own actions.